In Chapter 6, what we're looking at here is how, basically, what are the causes for interest rates being different across different asset classes. So this is now in essence, the third chapter out of 4 that will be dealing with interest rates. If we go all the way back, Chapter 4 was talking about what is an interest rate, right? And we talked about it in terms of yield to maturity and in terms of how to value a dollar received in the future versus one received today. Then in the previous chapter, Chapter 5, we looked at how the interest rate itself is determined according to the demand and supply for those various assets. In this chapter, what we're looking at is how these interest rates are different within even the same asset class, and then how can we explain those differences. So we need to basically look at why are interest rates, why do they adjust? What does it have to do with their maturity date as one possible reason, but also looking at it in terms of that even if they have the same maturity, meaning both have the same date of when the principal must be paid, that there'll be different interest rates for bonds at the same maturity if they have differing levels of default risk, liquidity, and tax considerations. Let's look at each of these. So, just as a general overview, if we look at how bond yields have changed over time, we see that we reach a peak 1979, 1980. My father and my parents, when they bought their first house in 1979, my father said that the interest rate on their VA mortgage was 14%. 14% for a mortgage. Well, that's in line at least with what interest rates were at the time. And the reason why interest rates were so high at this point was because the Federal Reserve was battling incredibly high inflation that was occurring throughout the 1970s. And so the only way to control incredibly high inflation was to dramatically reduce the money supply. And by reducing the money supply dramatically, it made money more scarce and drove up the interest rates. So it basically forced the economy into a recession, which it did have in 1981. And during a recession, businesses don't want to borrow money. Everyone doesn't want to borrow money to buy stuff. And so that's where you see interest rates going down. And so the Federal Reserve's actions to basically push the economy into a recession stopped this increase in interest rates. And then it declines until this point right here. And you'll notice that at this point here, corporate bonds actually deviate the furthest. And this is during the 2008-2009 financial crisis, where we see many companies with investment-grade securities basically having to pay unprecedented interest rates. I bought an AT&T bond during the 2008-2009 crisis, along with a few other bonds, and even that bond paid, I think, 6%. And that's for the, among either number 1 or number 2 in the United States for largest telephone company. So of course it was going to pay, I thought, of course it's going to pay its principal. Now, let's look at how bonds with the same maturity, how that, why the interest rates differs. So default risk is an obvious one. the bar for everything here is U.S. Treasuries. Although the U.S. has technically defaulted once in like the 70s, the computer made an error and forgot to make a bond payment. The perception is that the government is not going to default on debt. Most governments, most national governments, the United States included, can simply increase taxation to cover any principal and interest payments. So that's the bar. That's a risk-free, it's almost risk-free treasuries, security bond. Everything else deviates from that and involves a little bit more risk. So everything then must have a higher interest rate from that. So the higher the probability of default risk, the higher the interest rate must be to cover that risk that's being taken on. And so we see here, what's great about these pictures, and I like that, I like what the authors of the textbook did here, is that an individual who says, I want a fixed income asset, that's what bonds are called, fixed income assets. For an investor who wants a fixed income asset, you're basically trying to decide between, do I buy a lower interest rate but much safer treasury, or do I buy a corporate bond? And if the general perception increases that corporate bonds are going to be in default, then people will want less of them. And that's what we're seeing happening right here, where the demand curve is shifting inwards. But as it is shifting inwards, thus lowering the price of that bond, the assets are then being instead redirected to treasuries, demand increasing. And thus that risk premium increases, that perception of how much risk is being taken on for default by those corporate bonds. It's that difference that's right here. We can see here, in terms of the rating agencies, Moody's, S&P, and Fitch. These three rating agencies basically review debts and assign to different bonds a probability of default. AAA being the highest. Very, very few entities have AAA bond rating. The United States government does not. Largely because there's some concern about the continued ability of the government to increase taxes. And then from that, anything A grade is pretty high debt. And you're assessing a company's revenue lines, you're assessing a company's ability to make its principal payments. What are the chances that it cannot? Then you get into the B's. And after that, as you go down lower, it's no longer investment grade. C, D. These are basically C's are junk bonds, essentially. Hawaiian Electric, if I remember, is... Hawaiian Electric would be, at least in Hawaii, among some of the safest debt you could buy in Hawaii. I think it's double B, I think. Not triple B. Yeah. Triple B plus. So It is investment grade, but it's not great. And that's among the highest in Hawaii. Okay, so issues started to emerge in the 2008-2009 crisis when individuals then started to question the bond rating agencies. Were they reading these things that closely? How was their opinions? How was their opinions being influenced by the revenue they could make in other ways? If you watched that movie, The Big Short, I think, if I remember correctly, there are scenes in there where they go to see that like old woman that just had the eye surgery. I think she's Standard and Poor's. I think S&P, and right, they said, how could you rate these mortgage bonds? Could you give them such a high credit rating? And she said, well, if I don't give them that high credit rating, then they'll take their business to one of the other rating agencies until they get that rating that they want. Well, that's obviously part of the problem of the rating agencies is just because something is rated in a certain way doesn't stop you from, as an investor, of having to read things closely. So we've got default risk, then we've got liquidity. How quickly can I turn that bond into cash if I needed to? A lot of that is coming down to two factors. How much is it going to cost me to sell that bond in the secondary market? And how much volume is there? Is there a lot of individuals out there who would want to buy that bond? You see this being a problem for international bonds. Sometimes if a country is a developing country, they don't want to issue the bond in their home currency because that automatically, or that generally, will limit the number of buyers and sellers because they would have to buy that foreign currency first, then buy that bond, and then face the foreign exchange risk that when the bond comes due, that they need to turn that foreign currency back into US dollars. So the solution that developing countries generally do is that if they need to issue debt, they use a much bigger country. Mongolia, a developing country in Asia, generally puts their bonds up in Japanese yen. Many African countries put theirs up in euros or in dollars. One of the things we see as well is that municipal bonds, so municipal bonds would be like state, local governments, those bonds that pay interest, that interest, you don't have to pay taxes on it. It's exempt from federal taxation. So if an individual is trying to reduce their federal tax burden, they generally buy municipal bonds. These are called tax-free bonds. And all that a tax-free bond fund does is it buys a lot of municipal bonds. And so we can see this now here. What if I'm faced with a choice between a municipal bond that is essentially tax-free versus buying a treasury bond? Well, because these municipal bonds are out there, people are going to want to buy them if they end up being in a high tax bracket. So as a result, what we see in step one is that the demand shifts to the right. What that then means is that basically money is being reallocated towards municipals and away from treasuries. So that's why we see the demand for treasuries shifting to the left. And again, what we see is now a growing difference in the interest rate between these municipal bonds and these treasury bonds. We don't really need to, I mean, all this is really saying here is that if income taxes increase, then wealthier people tend to buy more municipal bonds. That's not that surprising. And then the third aspect, the third factor that's determining the interest rates, that's our, I guess our general perception of what the maturity rate is. So if we look at the risk structure rather than the term structure of the interest rates, under the risk structure we had default risk, liquidity, and tax considerations. Now, let's say that those things are the same, identical, risk, liquidity, and taxes. But now the maturity is different. So under the risk structure, we said the maturity was the same. Now we're going to say that risk, liquidity, and tax characteristics are the same, but it's the maturity that's changing. So now let's look at that. To understand these differences based on different levels of maturity, we need to generate a yield curve. That's going to be plotting out the bonds and looking at what the interest rate is versus when it comes due. Generally speaking, a yield curve can have one of three shapes. It can either be flat, where the short-term and the long-term rates are basically the same. It can be upward sloping, where the long-term rates are higher than the short-term rates. So this is all on the x-axis. On the x-axis, you've got shorter maturities towards the left, and as you increase the maturity time period, you're moving to the right along the x-axis. So upward sloping long-term rates are above the short-term rates, flat, short-term, long-term rates the same, and inverted would mean that the long-term rates are below the short-term rates. Let's just see. I think the Treasury will give us a pretty good... No, they don't give us a nice picture, though. Okay, I'm going to click on images. No, maybe it's right here. Here we go. An upward sloping yield curve, where as the maturity increases, the interest rate increases. And we can see here that the yield curve itself is getting steeper. Now, it's becoming less steep than it was a month ago, but it's still steeper than it was 6 months ago. What does that mean? It generally means that there's an expectation for more inflation as opposed to 6 months ago. But those expectations are less than they were a month ago. And you see that because, in general, those short-term rates. So, as the last number 3 points out here, yield curves are almost always sloping upwards. Generally speaking, the longer the maturity, the more of the expectation that you're going to have a higher interest rate to compensate for that. So why is that? In general, we have our expectations theory, our segmented markets theory, and our liquidity premium theory. So let's go. Let's start with looking at the expectations theory. So that's going to explain that interest rates move together over time, and that short-term rates are low. And then as the maturity increases, that the interest rate increases. Let's start first with expectations. So under the expectations theory of those three facts, we're essentially seeing that the way to think about what the interest rate is for a long-term bond is that it's essentially an average of the short-term interest rates. Basically, under expectations theory, we're not really saying that individual investors have a preference for one maturity over the other. Rather, different maturities can be perfect substitutes as long as the interest rate adjusts accordingly. So the fact that I own a 1-year bond versus a 3-year bond, not a lot of difference for me as an investor, at least according to expectations theory. Because all it's going to be is the average of the two, of the three bonds, the 3 1-year bonds. And we can see that in this simple example here. 1-year bond, 6%. And then for a 1-year bond next year, you are expecting, which is why this is called expectations theory, you're expecting the interest rate to be 1 year from now 8%. Then just take the average. Split the difference. 7% for a 2-year bond. Now, it's only useful to do this if you have a strong, if your expectations are well informed and reliable. You can do that in a developed country, but it's much more difficult to do that in a developing country. And so then the maths involved for this would be looking at my expected interest rate for future time periods. And we can see that here. So essentially, I'm taking an average of holding it over 2 periods, and that is reflective of 2 1-year bonds. As long as my expectations are generally correct, I should be indifferent between the 2-year bond and 2 1-year bonds. Now, in general, it has to be in terms of my expectations, I have to have well-reasoned expectations. And I have to be able to buy these bonds in these different maturities. There has to be a big enough of a market for me to buy these different bonds. Now, with that all said, that's how we then get our the first 2 facts explained for us. Why do different bond maturity dates, why do they move together over time? Well, because all that the longer term bond reflects is the average of the short term bonds. So they should move over time together. And why yield curves are sloping upwards when the short term rates are low, and then slope down if the short-term rates become high. It also explains that as well. Again, with the belief that we're simply averaging the different maturity dates of the bonds. Unfortunately, expectations theory doesn't really tell us why the yield curve is upward sloping. For that, we're going to have to use the segmented markets theory. Under the segmented markets theory, the belief is that the market is fundamentally different for bonds of different maturities, and that those are not those different bond maturities. They're not equivalent to each other. So investors actually do have a preference under segmented markets theory for one bond over the other. And that generally speaking, investors are going to want shorter bonds. And they're going to want that because they can't make a good expectation about what the future interest rate's going to be. And so because individuals then prefer short-term bonds over long-term bonds, that difference in that preference is going to explain why the yield curve is upward sloping. And then finally, we have the liquidity premium and preferred habitat theory. And here what we're saying is that bonds of different maturities, they are somewhat substitutable for one another, but they're not completely substitutable for one another. And that what you need to do is you need to place a premium on liquidity. Meaning that longer-term bonds need to have an additional source of compensation for the fact that there's less liquidity. So as this identifies here, is that the interest rate on a long-term bond is simply the average of the short-term bonds plus the fact that I lose my liquidity by having to wait for this bond to mature. So that's obviously going to explain well. That's obviously going to explain well the yield curve and why it's upward sloping. Here we've got, again, our liquidity premium here. Again, I'm averaging the short terms plus adding my liquidity premium. Under my preferred habitat theory, so we did liquidity theory, now under my preferred habitat theory is that investors still have a preference for one bond over the other. And they're only going to do this. They're only going to buy longer term bonds if they can get a higher rate of return. Which is still going to explain why our yield curve is upward sloping. And you can see that in this yield curve right here. That it's positive and increasing, and that positive difference between the two of expectations theory and the liquidity premium theory is that liquidity premium. You get some different shapes here of the yield curves themselves. I'm not too concerned with those. This is just explaining what the liquidity premium and preferred habitat theories then successfully explain. And in general, you're seeing here that the yield curve for U.S. government bonds is, for the most part, a lot flatter than we would think. And again, that's largely because there's no default risk and nothing else. Nothing else that's going to take, that's going to require an extra premium to be paid by the government for an investor to buy that bond.